This video is the third video in the series, which is trying to replicate what I talked about with my investors in my annual meeting. It's not lost on me that there are a whole bunch of really sexy tech companies out there, and that I've lost out on a bunch of potential returns for my investors by not buying these sexy companies. And so I'm going to spend some time talking about my very stupid decision not to invest in Nvidia. And more importantly, I'm going to tell you why, given all the same facts, I would, again, not invest in Nvidia today. So before I talk about Nvidia and why I didn't invest in it, I want to talk a little bit about what I look for in a company and how I do my research and how I invest. So this picture is an example that Warren Buffett gives in one of his annual reports about the way he thinks about investing. And again, what I'm doing is trying to replicate Warren. So this picture is in Ted Williams' book on the art of hitting. And what he's done here is he's broken the strike zone into 79 baseball size sections. And what he has also done is calculated what he thinks he would hit as a hitter if he hit pitches in each of these 79 or 77 locations. And you can see that if he hits the ball in the sweet spot, he hits over 400. And if he hits the ball in areas where he's not a very good hitter, he hits closer to 230. And Ted Williams' results in understanding this is he waited for his pitch. Now, baseball players can only wait for 2 strikes, and then they have to swing at the next strike or they strike out. But as an investor, I don't have any strikes. I can just look at strikes, pitches all day long, waiting for that perfect company that's right in my sweet spot. And having the patience to do that, I think, is one of the things that differentiates a regular investor from somebody who's trying to be a professional investor. And so hopefully this picture will sort of illustrate that concept for you. So what do I look for in a company? Well, I'm looking for a consumer monopoly rather than a commodity. A consumer monopoly is a company that has a place in the mind of the consumer for which the consumer is willing to pay more. So Coca-Cola relative to Shasta, or Wrigley's gum relative to some no-name brand. We're willing to pay more for those. I'm looking for companies that have that consumer monopoly. Some people call it a moat. I'm looking for high gross margins, which are, again, most likely achieved in a consumer monopoly, because a commodity is basically priced on what price the market will bear. I want consistently predictable long-term earnings, preferably growing over time. I want solid operating characteristics. I want high returns on invested capital. I want low debt and lots of cash. And I want management, so one of the things that makes my decision not to invest in Nvidia, the fact that I knew about it. So this, by the way, is a stock chart of Nvidia's results and performance since it was founded. And I knew about Nvidia. I had done the research on Nvidia, and I researched the company several times over the years, and I last analyzed it in 2024. And it is the 65th best company I've ever analyzed. It's solid in every category. It takes on a little data a little faster than I'd like, and it's selling shares instead of buying back shares, which I don't like, but very, very minimal issues. I really like this company. It's got, as you can see here, it's got 4s in virtually every category I care about. So let's look at it through a different perspective. It's a consumer monopoly versus commodity. Yes, it has high gross margins. It doesn't have what I consider consistent, predictable long-term earnings. I'll go over that in a minute. But it's got solid operating characteristics. It's got high returns on invested capital. It's got low debt with lots of cash. And the management efficiently uses profits and rewards shareholders. So despite all of that, and despite knowing it was a great company, and despite looking at the chart, I didn't buy Nvidia. And you're probably starting to think I'm an idiot. But here's the problem. My reservation for the company is that it's extremely expensive. It's trading at 55 times earnings. That's about 4 times what I'd like to invest the company. There's almost nothing that's going to make me buy a stock that's that expensive. I just think that there's more downside risk than upside. The next reservation that I have is I didn't feel the earnings were predictable in the medium to long term. So let me explain why I feel that way. Nvidia is a chip manufacturer, which currently has the hottest, sexiest chip. That chip, by the way, is almost completely an accident. Nvidia used to be a company which made chips for gaming videos. and video cards specifically. And those cards looked at data in a way which just happens to be very efficient for AI. They didn't set out to make the greatest AI chip. They made the best gaming chip they could, and it turns out to work for AI. And the result is the value of the company has exploded. But it was an accident, and I don't believe it's sustainable. I think that another problem with this company is R&D is way too large a component of this company's future. So let me go over what I mean by that. I've seen chip companies who fail to innovate fail. In other words, when you've got a chip company, you have to be spending a ton of money in R&D, and it has to be working, and you have to be staying ahead of the competition. And if you don't do that, then you are likely to become a company like Intel, which lost $16 billion last year. Intel's still spending a ton of money on research. Intel spent twice as much money on R&D last year as Nvidia, and yet they lost $16 billion last year. So once you begin to recognize that this is an R&D driven company, and you recognize there's no guarantee R&D is going to work, and you recognize you're buying this company at 55 times earnings, you start to go, wait a minute, maybe we should slow down the way we're looking at this company. But the fact is that I did like the chip companies, so I did research, and here's my analysis of all of the chip companies that basically are public companies that I've looked at, and my results for those companies. So when I'm looking at a company like Nvidia, I often will look at every company in the industry to find out what's going on in the industry, to find out what's happening in the company I'm interested in relative to the other companies, and also in case there's an even better diamond in the industry that I hadn't thought of. And so here are some of my findings from looking at the industry. The average score for the companies in the industry is 2.79%, which is above average, which means this is a very good, very strong industry. There are 6 companies in the industry that I would buy at the right price, Nvidia being one of them. The problem is that they have tremendous R&D costs, these companies in the industry. They spent over $75 billion in R&D in 2023 alone. The largest R&D spend of those companies was Intel, which spent $16 billion and coincidentally lost $16 billion last year. So that tells me that R&D isn't a guarantee of success or a guarantee of future profits. 2 of the companies in the industry lost money, the largest being Intel. In addition to that, there are a number of non-chip makers who are both competitors and customers. Apple spent $30 billion on R&D. A significant portion of that was on chips. Intel, Meta, Amazon are all spending money in R&D. They're also very, very large customers of Intel. And so when your customers are spending billions and billions of dollars to try and stop being your customer, that should be a red flag. And again, Amazon, Meta, Alphabet, and Apple are all spending in excess of $30 billion each in R&D. Now, to be sure, not 100% of that is in chips, but a significant portion of it is. And it's a very, very big red flag for why I'm not currently interested in investing in that industry. So what are the conclusions? Well, I believe Nvidia is priced for perfection. 55 times earnings means nothing can go wrong. If it does, your investment's in big trouble. Its only advantage is the current model of chip that it produces. That advantage could go away tomorrow. All that has to happen for Nvidia to become less valuable is A, someone needs to make a faster chip. B, someone needs to make a cheaper chip that's just as fast. C, someone needs to make a chip that's more energy independent. Or D, the current money that's being spent in creating AI has to reduce by, really has just remain flat. If any of those things happen, it's going to destroy Nvidia's advantage. Chips are simply a product of R&D. There's no compelling R&D advantage for Nvidia, and the industry is spending over $100 billion in R&D, and Nvidia is only spending 8% of that. There's no compelling R&D advantage, and so let's talk about that for a minute. So Nvidia spent $8 billion on R&D, and let's just presume that they're better at R&D than everybody else. Okay, fine. Let's say that's true. What's to keep everybody else, $100 billion being spent on R&D? Why wouldn't you just go and steal away the best researchers, that NVIDIA has? Why wouldn't you just go and replicate exactly the research facilities that NVIDIA has? NVIDIA has no ability, that I believe, to maintain their R&D advantage or to retain the results of their R&D advantage, and thus there's no reason to believe NVIDIA is going to be better, especially when they're only spending 8% of the over $100 billion being spent by the industry in research and development. The next thing that I have to tell you is I lied to you. When I showed you this chart of NVIDIA, this was not a chart of NVIDIA. This was actually a chart of Intel. And this was a chart of Intel leading up to the dot-com bubble. And you can see that since then, it has never been as high as it was at the peak of the bubble. And so where I'm going with this is buying stocks in a market you think is a bubble when the stock itself seems to be very, very high priced is potentially a recipe for disaster. If you had bought NVIDIA at those super high prices, you would today still be below the price you paid 25 years ago. So to be fair, here is the chart of NVIDIA. And again, it's just going straight up. And when you looked at that Intel chart, you might have paused that maybe that's not sustainable. The only problem is I lied to you again. This is not a chart of NVIDIA, it's a chart of a company called Cisco. And you can see that Cisco reached again an all-time high in 2000, and as of today, hasn't 25 years later been worth more. By the way, Cisco is a great company. We own Cisco as a stock. I like the stock, but I bought it many years later, and it's gone up since we bought it. But if I had bought it at the peak in 2000, we'd still be losing money. So here is actually the chart of NVIDIA. And I believe it's too eerily close to the other companies. And when you consider all of the factors that I've talked about in this video, hopefully you get a sense for why I avoid super high risk, super high technology companies in the middle of a bubble. And again, I know the stock, I know the company, I've looked at it, I understand it very well. Despite the fact that it's up whatever it is, 200% over the last year, we won't be investing any money in that stock or anyone like it. And I hope as an investor, looking at it dispassionately, you can agree with me. So that's my video on NVIDIA and why I wouldn't buy it. Thank you very much for your time.